Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? Phil Tarrant. Welcome to the Pure Property Podcast for 2026. I'm your co-host, back for another year, navigating property investments. And we're going to kick off 2026 with a really engaging episode, which I think will set us up and maybe give you some inspiration for how you can shape your investment decision-making over the coming year. Joining me back in the studio, the founder and CEO of Pure Property Investment. And I just see he's put his book, he couldn't help himself, in front of him while I was chatting to you. Paul Glossop, how you going? There you go. Service Guide to Property Investing, the next wave.
I'm good, mate. I'm good. I've got a fresh January tonal change, which usually makes me happy. It means that I've been doing very little, which is one of my favourite pastimes.
Well, if you remember, and again, any chance I get to talk about Paul's book, I can't miss it, but I have a surfing story connected with today's podcast, in that you bought your book out. For the first time ever, at this time, I was going to go to the wave park.
Really?
Yes, and it was booked. And,
unbelievable. You didn't tell me that. We could have moved the whole podcast.
Yeah, it was booked.
There.
It was booked with some blokes that you would know, Adrian and Eric and Michael. And it was all booked, and we said we'd go out, and Adrian just booked it and said, "This is when we're going out. This is the time." And I went, "I can't do then."
Well, you could have. This is the first time you've shared this information with me. You know what I would have been like. All right, mate, we can record this on the phone and just plenty of excuses.
Committed to property, passion for property, pure property. But yeah, there's a surfing anecdote.
Well, there you go.
Maybe we talk about the service guide
to the next one. How hard would it be to up the studio potentially in a very poxy form and go and book out one of their little meeting rooms there and do a full day?
I think it's a great idea.
Yeah, Momentum are happy to cover that. You don't ask, you don't get people. You don't ask,
crisis.
You don't get.
Maybe
you might be doing the Macarena when you're there. Eh?
Mate, talking on the fly. Maybe you can do a later session, and we could record this live out there with some of your clients as well. Turn into
Done
a thing,
deal.
mate. Get 10 or 20 people out there, and then we can break some bread and
you pay
and drink some bin. I don't know what they said. Drink some bintang. I was going to say.
I don't think it's the right. We can drink something, whether it's mocktails, mojitos, and
proudly sponsored. It could be a 2026 relaunch of your book.
Okay, done deal
out there.
All right,
you can even do boogie nights for the boogie boarders.
Boogie nights for the boogie boarders. We do it in warmer months, February or March. It has to be. It gets a bit too chilly. Later in the year.
So there's a surfing.
That's done deal. All right, we can get AB out there and a few of those other guys. I'm sure they've got some good stories and anecdotes. A few of those are around property, pure property as well.
Yeah, there you go. Anyway, so welcome. Today's podcast just set us up for 2026. Now, I often need to give myself some perspective as someone that works in and around property quite a lot. You start thinking that, and because you surround yourself with people who have a similar sort of investing journey to you, it becomes very normalized, this idea of owning many investment properties. And that can sometimes impact or shape my discussions, where I just assume that everyone else is doing that. And that's not really the case. Property investment in Australia is about 29% of Australians invest in property, and most Australians only have one property. I sometimes fall in the trap thinking that, and I talk with and for investors around this concept of owning multiple properties, and by multiples 10, 20, 30, that is not the norm. However, that's something that a lot of people aspire to, or they see as inspiration to work towards in a property investing journey. I don't want to deflate everyone's boat, but most people won't end up with extremely large property investment portfolios. Structurally, it's very hard to achieve. However, what I want to do is kick off this series of the Pure Property Podcast for 2026 with conceptually and philosophically some ways in which you can shape your investing journey with a view to potentially growing a large portfolio. And fortunately, I've been navigating property investment for 10 or 15 years. I must have spoken to thousands, if not tens of thousands of people that invest in property or are connected with property. And I've got two people in the studio here who are probably very similar through a different lens. So Paul Glossop, who's the director and founder of Pure Property Investment, and also joining us in the studio, Munzurul Khan, who is the founder and the managing partner of KHI. Between us, we've probably spoken with most property investors in Australia. So today we're going to really conceptually look at what you need to do mechanically to invest like the 1%. The 1% being those number of property investors who own 5 or more properties. And when you look at the numbers, Paul, it's quite significant. And I did a quick search before we come on air here, and just to break down the stats here, 20% of taxpayers own investment properties, mostly with just 71%, with a significant concentration where 1% of investors own nearly a quarter of all investment properties in Australia. So 1% being those that own 5 or more properties. So that's significant. But it's
Extremely.
small when you think about it. So 2.29 million working Australians, or 20% of taxpayers, own investment properties. Now, this number's a bit skewed because I don't know if it pulls in trust type stuff. It's probably in personal names, which is the majority of people. But to be the 1%, it's extremely rare.
It's obvious, yeah.
And welcome, Munzurul.
Welcome, Munzurul.
Thank you.
And I think Munzurul is going to do a lot of talking in today's podcast. And the reason why I wanted Munz on the podcast personally is that I know, and you know too firsthand, Phil, is that there is not many people who get to speak to and work with and also be partly the orchestrator of large property portfolios more than Munzurul Khan and his team at KHI. But I guess the thing that resonates with me, what you were saying, is that disclosure, the three of us sitting around this table are part of that 1%. Now, I know, and I'll speak personally, I didn't start property investing to become part of the 1%, but I did start property investing because I knew personally that it was a mechanism for me to build a better life financially, and also to make sure that when I did choose to not work, or when I did have something to hand over to my next generation, that I wanted more than just what my superannuation would be. They were the sort of the driving factors way back when I started. Now, how I got to the 1% was part of what we're going to talk about today, and I'm sure there's a lot of different learnings there, but I'm excited to have Munz on board because I know firsthand that he's probably spoken to more of these 1%ers than potentially. I don't really know anyone else in the country who probably has spoken with more as a volume and been part of that mechanism.
Yeah, and I think very sensible bringing Munzurul into the chat now. I'm fortunate that I get to speak to a lot of people in and around property investment, property investors, but it's normally a sort of a veneer. I don't get into the nuts and bolts of it. Whereas Munzurul, because of the nature of the work that he does, as a sort of tax and compliance and structure expert, but then also all the things that cascade out from it, which I know KHI do, like insurance and mortgages, etc. He gets to actually look mechanically at it. So we want to pick your brain and uncover what those secrets are of the 1%, and I wanted to be a mechanical and strategic conversation, but we can't have this conversation without at least an acknowledgement towards mindset and goal setting. So let's start there, Munzurul. And I don't want to drill too much on this because it gets spoken to a lot, but what do you see from your cohort, and the same thing applies to you, Paul, which differentiates those people who from a mindset point of view can actually move into this 1% bracket?
No, very good. Thank you very much. Thank you. Thank you for having myself, and Paul, thank you for inviting as well. Thank you, Phil. Without going too much details in the mindset, right? I mean, people speak quite a bit in terms of the SMART goals, and people sort of say that you need to have a direction. You almost need to sort of dream sort of where your sort of the end goal is, and you sort of go backward behind it as such, right? So we know that it's being spoken quite a bit. I think where people fall short quite a bit is that we're sort of a bit better in terms of having that first goal, but how do we follow through that goal on an ongoing basis? That consistency and that persistency piece is the one that perhaps we don't do as well. Yeah, it's like a gym, right? In January and February and January, you go to the gym and everyone is there, right? It's the New Year's resolution, the gym is being full. And then when you go into February and March, it sort of go back to where he was, which was 20% as such, right? So that's the bit is quite fundamental. And where it comes in is that you set that goal and you almost give yourself a time frame saying that whether it is December, whether it is say July, that is sort of every year revisit. And in an ideal world, if you have someone else to be accountable to, and someone else, it doesn't necessarily even need someone else to know more than you, is that if you organize that time saying that, all right, we'll sit down every January and we'll sort of revisit on a mechanical way with the sign saying that I've created that 10 different goals, how much have I achieved? And do that on a consistent basis. That's a start.
Okay, so mindset is key.
Yeah.
And mindset is something tangible in that it's something that can be worked on constantly and it needs to be revised and connected with. And, I do it myself. I set bold plans and then I get disrupted doing other things and goals go out the window. And I find typically in my list of priorities probably comes right down the bottom often to my detriment. And you must see that in a lot of your client base. Part of your role, Paul, is accountability for people. So what's that mindset? What sets? Before I go there, give me a sense of does your cohort of clients represent the statistics that we see here from ABS, or is typically if people are using buyer's agents, they're probably more towards multiple properties?
They're definitely by a long way skewed towards multiple properties. And it's not because of any other factor other than they're buying property for an outcome, not for the sake of saying I've got a bit of spare change and I need to lower my tax, so I'll buy an investment property, which unfortunately a lot of that sort of that 80% cohort who own one property typically fall into the trap of. But I guess most people who work with us at Pure Property, and if I'm having that first meeting as a new client, we are always talking about where do we want to get to. It's not what can we do, is what should we be buying as this first property? Is that where are we trying to get to and how long do we have to get there as part of your plan? And if they don't have an answer to that, that's where we'll start. Because without shaping that, the rest of it really just becomes a bit transactional, and far too often that means that people are just going to stop it saying, I bought a property, I've ticked off that box in my to-do list for 2026, and I guess that's probably where it stops. It will achieve something, I dare say, if they're in the game for 10 years plus, and that consistency and persistency, those two words that you use, Munzurul, are key to achieving things in property that most can't. But if it comes down to the mindset shift, and what I try to make sure that we're probably trying to shape in that analogy of a gym, someone who starts at the gym and gets a membership, being that personal trainer and holding people accountable when things go right, but when things don't go according to plan. And I can speak firsthand, and we were speaking off air, Munzurul, you mentioned about a number of properties that have had damage by a fire over the last 18 months that you own. I can think of in this year alone, in 2026, I've had close to a dozen emails from different property managers about repairs and maintenance that have come up, and they've all happened at once. And I would go back to the previous 6 months. I couldn't think of a single time I got an email or a phone call or a text message about damage to a property. If my mindset wasn't of the fact that this happens, it will continue to happen, I have all of the other things in place, be it the cash reserves, and my mind is, hey, this is part of the journey, I would have lost faith, and I certainly would have got frustrated with the process, and I probably would have think, you know what, this property, I constantly get these messages, I'm out. That's the part which having the mindset and the ability to maintain consistency, persistency, and knowledge that this is going to be okay and this was all part of the plan in the first place allows you to stay part of that journey. Because I can think of probably half a dozen properties that I personally own, which if I had a shorter tether and a less ability to weather that storm, I just would have said, can you put that thing on the market, please? Because I'm not interested in these messages anymore. And I do find that that's a big part of getting people conditioned up front to be able to build their portfolio to become part of that 1%. And I don't know really any property investors I could say off the top of my mind who don't have the ability to weather those storms. And if they don't, they typically can't get past that one or two.
Yeah, a number of points in here. Loved it, what you just said, right? One is that a sense of pragmatism. Second is that a sense of looking into your bigger picture. And number three is that having that flexibility in the mind. The pragmatism comes in, and the bigger picture as such is that very often I sit down with a property investor, say that, how was the last year? And the investor said, oh, it was a disaster of the year, right? Like, we had to do this roof and we had to do this hot water system and the carpet gone off and we didn't have the tenants on that many months and so on. We say, okay, so those sort of things happen. Let's add away, right? Yes, I've lost a bit in terms of the cash flow side of it. Yes, we lost a bit on terms of cash flow. We don't want to lose it. But we lost about 20 odd grand. There is a tax benefit. We set aside the tax benefit. Then we look back saying that, how did it go in terms of the growth side of it last year? Oh, it did reasonably well. I was like, all right, let's do the maths. And once you do that math, that growth as opposed to a little bit of that cash flow that is sort of lost. So there's a huge, you can't even compare that with that sort of the cost, compare with that growth. So, right. So that's number one, is that in terms of that sort of the bigger picture. Pragmatism in the sense that you almost sort of say that if you hold property for a very long period of time, right, is that all Murphy's law of average. Whatever is supposed to happen, it will probably eventually happen at some point of time. You almost budget that, right? So you're having a lots of good sort of year. It doesn't necessarily mean it's good. It means that the bad will happen. On the other side is that when we had those couple of bad news, means that the good news are on the way. And the last comment which I want to say is that it's sort of almost to stay flexible in terms of your dream, right? I mean, we can sort of sit down in here saying that, yes, we all own a number of properties. In day one is that when I started my first goal, that was back in 2005, all I wanted to have is $1.3 million gross asset. $1.3 million asset. That was enough at that stage. 300,000 would be my principal place of residence. At that stage, 300,000 was okay. And 1 million, that was my retirement plan. Now we look back and we sort of say median price of Sydney higher than 1.3. So you've got to be flexible, that you sort of say that 1.3 is what we start with, but as time goes on, you grow and grow and grow, both into your goals as well as your action.
I was just going to say that, going back to that mindset part, and it's funny you mentioned that, it sparked the mindset of when I first started, Phil, was didn't plan to own a number of properties that put me into the top 1%, but I did have a goal that I shared with my girlfriend and now wife, which we had a goal, which was to get to the point of $1 million in net equity.
Yeah.
And I remember that was the goal. It wasn't to say we buy one property and it'll turn into that, but it was the goal is let's get to that. And how we get to that turned into a number of properties, renovations,
That's it.
Yeah, all the other things that led to where we are today 20 years later. But it was $1 million in net equity. And less than 20 years ago, that was more than enough for what we needed at that time. Now, all the things like lifestyle creep and pre-kids and pre-everything else. But at the time, we knew that if we could get to there, based on everything being equal, that would be a comfortable position in life. Now, it's evolved.
And I think, what it shows, Paul, your example, my example as such, is the power of the property, is the power of that compounding impact over a period of time. All we have to do is that we have to be on the game for a good, long period of time. We don't need to do a lot of extraordinary things. It's okay to do a lot of ordinary things, but we have to do lots of ordinary things, which by itself will become extraordinary.
And that's a really important aspect of the top 1%. It's easy to throw around words like consistency and focus and all this sort of stuff, but it's patience, right?
Yeah.
And patience in property translates into time, and time is the enabler which drives capital growth, right? So, these are all nice. These are all good philosophical concepts, and you can say, mindset, the best 1%, the 1%, mindset, yeah, so what, right? Like, it's got to get down to the tactical applications of what you need to do, structural aspects of investing, like the 1% who own more than 5 properties, which is a fraction. That's 1% of property investors. It's not 1% of tax-paying Australians. 1% of property investors, which is about what 20. That'd be about 20-odd thousand.
Yeah.
Like, there's not a lot. That's Shark Park full, right?
It is.
It is
on a good day.
On a good day, the ScoMo's out there.
Yeah, exactly.
Number one sort of holder, and so let's actually talk about it strategically and tactically, right? So it's nice to go, I've got a great mindset. I'm going to be in the 1%. Like, structurally, a lot of Australians aren't ever going to be able to manufacture this. But there is still people who buck the trend and lower sort of earning capacity, if they do the right thing, can actually break through this and therefore sort of change their future. So how do you actually go about doing it, Munzurul?
Yeah, and we start with the knowledge. Yeah, and we start with the knowledge, we start with the learning, and we start with that ongoing learning. And I sort of almost subdivide that sort of the ongoing learning in between the technical learning and the operational learning, so to speak. Yeah, technical learning is that if we look through with a larger portfolio, so 6 properties, 8 properties, or a certain number of properties, you can't be buying all of those properties with the cash. As a matter of fact, none of those properties we buy with the cash. So finance needs to come in. Yeah, so we'll go quite a bit deep dive with the finance and as part of it, right? But one needs to be very clear in terms of the finance. So as an accountant, I can't be an expert in a mortgage broking, but I still need to know enough on the mortgage booking in terms of the finance side of it to know the pathways that how do I get that funding from the banks. It's not about having a solution. It's about knowing what do we need to do to get a solution. And that's so fundamental, that finance. People who speak quite a bit in terms of structure and accounting and self-sustaining trust and all the rest of it, which are all important. But unless and until we've got the finance and we've got a mechanism to know how do we get the finance, everything else sort of becomes more sort of academic. That's number one. Second,
sorry, before we go there, so can we just assume then, unless you come from a super wealthy family, you're never ever going to own multiple properties if you don't take on debt?
Absolutely.
Is that a fair call to your point around finance?
Absolutely. I mean, if I look back into my investment, there is no inheritance. It's a first generation. Yes, I've received a lot of guidance from my parents, but it's really is a first generation sort of a wealth. And all I did is that my very first property which I bought is that I had $24,000 saving, and my salary at that stage was $36,000 annual salary pre-tax, right? So $36,000, and I saved $24,000 for close to about 2 years or so. It took me to save. And
Jesus Christ, that's some heavy saving.
That was heavy saving. I was a good saver at that stage, right? And that's all I did, is that in terms of buying that one property at that stage, right? So there was an 80% funding, and one had to understand how you go to that 80% funding. There has to be a debt, right? How much is that debt? It goes back into the individual risk profile and many other things. Without the debt, there is no way you can scale over a period of time.
Okay, so be comfortable with the concept of taking on debt.
As long as the cash flow, we're very careful, right? And that's where it all comes back. It's not so much the debt and the quantum of the debt, which is important, but it's more sort of what does that quantum of the debt mean? So when I sort of say that, okay, $120,000 is the property that I bought, $24,000 that I did the deposit, including a couple of incidental costs, what does it mean with that balancing of that 90-odd grand, 96 grand of the debt? How much is the debt? What's my rent? What is my net rent? What are the expenses, that repairs and maintenance that you said we make an estimate? How much am I out of pocket, if any? And am I comfortable with it? Can I multiply that number of times? So if I'm out of pocket by $100 a week, can I afford $100? Can I afford $500?
Okay.
That's a really interesting distinguishing factor, because I think you initially saying you need to be your own finance expert. You don't need to be an accountant to know your own P&L in how you run your life.
Yep.
You know that you're earning $34,000 a year. Was it 34? $36,000 a year. You'll know how much tax you're going to pay. And then from there, you make decisions into what does your lifestyle cost you. So you then need to say, okay, well, if we live here and we pay rent here, or we live at home and we have board and lodging, or if we can get a good deal where I just help out around the house for a period of time, whenever you're starting, or I'm going to go flat share, or I'm going to go rent a waterfront, I'm going to pay an infinite amount of money. These are all decisions which dictate probably the number one expense in your life. And then it comes down to lifestyle, recreation, holidays, all the other things that come with it. What you're left over, essentially, you are the only person who's going to actually know that number better than most. And you also have control of that number within reason. So I think without knowing that up front, property investing to get from property number 1 to 4 to 8 to 15, whatever it might look like, is pretty much going to be a non-event until you get comfortable and familiar with that number and how to dial it up and down to be comfortable with your money in, money out scenario.
Absolutely. And may I still take that sort of point that you said about the patience? And I want to just go a little bit deeper on that patience as well. When we say about that 5 properties, 6 properties, and 10 properties as such, right? It's not going to happen in one day. It's not going to happen in 1 year and 2 years. Like if I look back into my portfolio in the first 5 years, all I could do was to buy 1 property per year. I could not, whatever I did, even with a single income, even with a double income as such, living with my parents at that point of time, I was a great saver. With all of those things is that I could not buy more than 1 property. But now I sort of look back after, say, 25 years or so, things become so much more flexible, right? Because if you have 1 property, all you're relying either on your savings or the equity gain for you to buy the second property. But once you have 4 or 5 properties, it's that whole compounding impact. And I think that's one of the things that I see with some of the younger sort of the investors at time, is that just that patience, just that sort of that longer term view is that, you know, you are early 30s. And if we look through the lifespan, quite a bit of time.
And to the point around age and looking at your, to again put a bit of perspective into it, like those clients that you service with 5 or more properties, what sort of age are they?
The first comment, if I may say, is that many of our clients, and then I would probably say literally about 9, close to even 10 out of 10 of those clients, they all started with zero. And they're all sort of, I'm generalizing, but they're all sort of, there is no inheritance. There is no additional funding. They all started the story that I share, the story that Paul's sharing, that's sort of all my clients are. They're all starting at that point of time, right? And what sort of age bracket? It's interesting because there's sort of almost no age bracket.
Yeah.
And then if I look back, say 15 years ago, 20 years ago, is that the age bracket was more sort of late 30s and 40s that people sort of are starting. But one strongly argues is that the knowledge is because it is so widespread, is that people generally starting a little bit earlier as such. We're seeing more and more people of that sort of under 30 and you've got a decent portfolio as such.
Yeah, and this is the point, you can't compare your chapter 2 with someone's chapter 8 or chapter 9.
Yeah.
Which is key. So be comfortable, familiar and knowledgeable around finance if you actually want to invest like the 1%. If you're not willing to take the mantle to educate yourself and inform yourself, you're probably not going to get there.
Absolutely. The high level of the finance, right? The high level of the finance that, say, in day one, as an example, that when I was doing those properties, is that there were lots of no's, right? One property per year means that there were like hundreds of no's before I had that second property. And I remember that every time when I had a no, rather than being discouraged, I used to go back to them and I used to say, show me the method. Tell me the science behind it, why the answer is no. I've always sort of said is that if the bank says no, I'll accept it. Because bank is in the open world to give us the lending. So if the bank is not giving us the lending, there is a reason why the bank is not giving us the lending, because my risk profile would have been high at that stage. So I would not be taking that risk. But I still want to understand what is that risk is. And I remember that I used to have those very detailed conversation. Knowledge was quite limited at that time. Detailed conversation. Tell me why the answer is no. I used to go through absolutely nitty-gritty with the math side of it in terms of the serviceability, why the answer is no. And more you go into the nitty-gritty, you sort of say that, well, there is a science, I accept that, absolutely I accept it, but there is an interpretation of that science as well. There is also a presentability to it, and there is a storytelling. And very often those storytelling and the interpretation, it makes a huge difference in terms of this is what I can get at a funding, and it's just that story being presented in the right way. This is what we get with the funding. But that doesn't come in without the time being invested into really taking passion of knowing the finance.
Okay, so mindset, tick, finance, tick, great.
Yeah.
So you can invest like the 1% straight off the bat. Your first property, if you bought a unit block with 5 units in it. So
Yep. To get the funding for a unit block, different story.
different story. So I just want to acknowledge the fact that we're talking about the number of properties. We're not talking about the value of the
Correct.
properties. So
Exactly.
So you could go out and buy 5 units. I'm going to pluck it somewhere Broken Hill for under $1 million.
Easily.
Yeah, you're in the game.
Today.
You're in the game. Or you can spend that same $1 million to buy a place in Kalunga or something.
Important point to bring up immediately, I
yeah.
think, Phil. And we could have opened with this, but it's certainly something that I want to address in this, is that being part of the top 1% with 5+ properties, you could achieve it with one property that was selected correctly. And certainly it's never been and never will be a game of who has the most properties wins. You certainly, we haven't talked tactically about the asset selection yet to say how important it is. And a lot of the time, 2 or 3 properties will trump 6, 8 properties, which are inferior, lower value, very, very often. So there is certainly going to be a discussion point there. Absolutely. However, it comes back down to the finance conversation that sometimes getting to that higher value property really just can't work because the cash flow is not there or the other things that go with it. So yes, to answer the point, and it doesn't mean that we always have a strategy to say, let's get to 5 properties as our goal. If they're $250,000 a pop versus one good asset at $900,000, that's certainly never going to be the way we want to go either.
And this is why, in some ways, this conversation is flawed in that we're talking about the number of properties and you're comparing apples with orange, right?
Yep.
Oranges. I would like then, and this is to our friends over the ABS, do these same numbers but based on the value rather than the number.
Yeah.
And I think you have a very, very different
any properties
and
that's not the
around
principal place of residence, the average value of your assets per property investor would be a much more meaningful and interesting conversation. And then coupling that with the actual revenue earned per dwelling would also be an interesting one too, to look at the yield per asset on average.
Yeah, all that. And 2.29 million working Australians invest in property, right? So they're saying 1% own almost 25% of all investment properties. I reckon if you did these numbers based on value, it would be even tighter.
You'd have to assume, though, that once you get to it's a large sample size of close to 3 million people, you'd have to assume that the average value of assets ends up being close to the average value of the Australian property market, which might be circa $800,000 average price per property. But it's what wedge of each one of those cohorts. That's where I think it would start moving differently, because potentially, do the higher have lower value, higher number of properties have lower value, or is it the opposite? That's where it becomes interesting.
Well, I just want to make this comment because you and I, we work very closely with many of our mutual clients, right? One of the things which I see very often in terms of when a new client comes in, the first 1 or 2 properties is that you take quite a bit longer term strategic view in the mind.
Yeah.
It's sort of almost that building block, right? If the first 1 or 2 properties are being bought wrong, then the whole journey becomes that much harder, right? So that whole asset selection, what's the definition with the asset selection, right? A couple of things comes into my mind is that it's the longer term growth potential. Because initially, yes, cash flow is always important. Of course it is. Without the cash flow, we don't have it. But if we don't have that growth over a period of time, and without having that growth, you don't have that additional level of the equity for one to draw down to go from 1 to 2 and to 4.
I'll bring up one point with that too, and this is probably a reverse engineered scenario of that, where I think someone who's actually a mutual client of ours, I won't name Munzurul, but they came to us via a recommendation from yourself a long time ago now, and they actually came to us where they had a large portfolio. They were in the 1% well and truly, and they had a large portfolio of assets which were averaging at that time, and I'll go on a limb, probably say they're about $220,000, $240,000 per asset. This particular client or couple had a strong average annual income. They had circa 20 odd properties when they came and saw us, but the actual overall value of the assets was probably no more than 4 or 5 million at the time. Majority of their assets were 1 and a couple 2-bedroom properties in regional locations scattered up and down the eastern seaboard. Now, they got advice to buy these properties. In retrospect, they've sort of came to us thinking this probably wasn't the right way, because they could have afforded to do it very differently. Maybe not bought more in value, but bought differently. They kind of didn't get anywhere. They bought a whole bunch of properties within a couple of years, thinking that was the strategy to get to an early retirement, essentially. We took over, this was probably 7 or 8 years ago. We're still buying for these particular clients now, but we've only probably managed to get to maybe 9, 10, 11 properties in addition, and they could do a lot more, but we've focused more on the growth component, because cash flow has never been an issue with these particular clients, in the sense that they needed to have an income to borrow more, or they needed to have an income to be able to service the debts. So they've been exponentially more successful in the growth of these assets, and we're actually strategically now trying to figure out when they should consider selling some of these earlier purchase properties, because they're just redundant in their portfolio. So it comes down to saying, do you need that 6 or 7 emails that come at the start of a year because someone wants to have their hot water heater replaced, or a fan's squeaking, and all these other annoying things which just have assets which aren't doing anything and never will do anything above the average as well. So going back to that point that we've talked about, is that it is certainly never a cash flow first, growth second. In almost every single case, we have to start with how do we proliferate the portfolio in growth, in dollar value.
I agree. Absolutely, I agree.
So to invest like the 1%, you can't be yield orientated at the front end. You've got to be capital growth orientated at the front end. Yeah, it's a simple concept. And therefore, in terms of strategy then, it's about identifying the right assets at the right time to acquire to give you that growth. So largely the market you invest in will do the majority of the heavy lifting in terms of delivering capital growth.
Absolutely.
There's not many other ways you can get that same significant uplift without it.
And I would say personally that is probably where a lot of people make that initial error, or even in the second or third asset, is they're trying to pick the perfect property as opposed to trying to locate the asset in the area. Generally speaking, that's going to do the 80% of the heavy lifting. And when it comes down to it, that is the biggest concept that people need to acknowledge when you want to be a long-term property investor, is that if you're not buying in the correct area at the correct time and the correct asset, then you're missing the point altogether. And far too often, I think people focus on the asset itself as opposed to the location, the budget, and the property type.
You must say to myself, how hard is it to get that right?
You would never get that perfect, yeah, and it's sort of many sort of almost perfect, not exactly perfect. That by itself makes it perfect, right? So there's many elements comes in, right? I always sort of say exactly the same as Paul was sort of saying, that how we start with the first investment, perhaps residential, yeah, how we start with that first investment property residential with some growth into our mind, right? But you always still need to do the cash flow, because if you go too heavy in terms of the growth, absolutely agree with the growth. That's what I say, right? But if we go too heavy into that sort of the growth side of it, you would take away so much cash flow that by itself will become a deterrent. Yeah. So it's sort of almost a balance. Location is always first. There's no question to it. You take away that location first. Absolutely location. Then what you do is that in terms of that property side of it is that strategic buy. Yeah. So however beautiful the home is at the moment, however new the home is, over a period of time, it will become older. It's a depreciating asset, the house by itself. What is appreciating asset is the land component. What is appreciating asset are the opportunities within that land component. What is appreciating asset are the manufacturing growth potential. So what you do is that my view is that you bring in all of those sort of a component and say how many of those that I can put into that sort of I suppose that cooking pot, so to speak. So about that residential property, that's a tick. About that residential property, which has got a decent level of rental return and it sort of doesn't cost me that much, that's a tick. About that residential property, which is a good location, it would do very well. Cafe culture, close to the clubs and close to your restaurants and so forth, right? So that's when we give a tick. But more importantly, is that we buy a property which has some potential manufacturing growth potential. Could be as simple as is that you convert a carport into a garage. You can add away a third bedroom, right? It could be as simple as is that we build a granny flat attached to it. A corner block as an example, that can we subdivide that land component to it, right? So those sort of manufacturing growth, as long as the cash flow in present plus the future in our hand, is perfect.
So you've just looked at, so this is what you can do other than getting the capital growth driven by the market. This is where you're manufacturing things. You spoke about some things there like granny flats or trends, adding value. I guess I imagine what you do at the front end of your portfolio building would be very different to the back end of it, you know, and you sit there talking about putting a granny flat on. Like I sit there sometimes thinking, it's just not worth the effort, right?
Yeah.
Like, is it really going to make that much different? But
Good question.
unless you do that at a point in time at the start of things where you sweat the small stuff, as in like getting a 20K win here or a 50K win here, like now you get to a point where you just go, I just can't be bothered, just not really moving the needle for me. But you've got to do the work at the front end.
Absolutely. And where one of the comment that I want to really go a little bit deeper to it, right, is that you always have to do the maths on the basis of where you are right at this stage. You can't sort of almost count that potential in advance. And what that means is that a common pitfall that I've seen many of the investors is that they say, oh, we love the land banking, right? So I'm sort of buying this property, which I know that over a period of time I can demolish, I can build 6 townhouses and 6 villas as such. Great, fantastic, good buy. The question comes in is that when are you planning to do that bit of the construction as such? Oh, I might not do it for next 10 years, right? But if you don't do it for next 10 years, you got to count for that cash flow. That how much am I going to give away that cash flow over 10 years? And what is the opportunity cost of giving away that cash flow? You know, that old saying is that once in a lifetime property and property opportunity comes in every other week. So even if we give that away, we will find something else. So I always do the math saying that I want to have a potential, but I'll almost assume that potential is being unused. The numbers as it is it still a viable asset? And if it is a viable asset, I'll leave that opportunity in our hand. When the time is right, if the time is right, we will do it. An example on the granny flat is that very often what the investors find is that because the interest rate goes up and down, right, there will be a point of time that the investors will sort of find that I can't move any further. I'm being limited with my serviceability. Those are good times to go back with the granny flat side of it because it's a short, sharp, sort of a smaller bit of a loan, gives you quite a boost on the cash flow side of it. Does it make a huge difference on its own? But when it comes back to that whole bigger picture on the multiplier, it makes a difference.
And you mentioned developments there, and maybe you can speak to this, Paul, but a lot of the reasons why a lot of people won't get to the 1% is because they try and accelerate the journey in a way in which undermines their ability to get there. And to your point around, someone buying a potential development block, it's a great block, I'm going to develop it one day. That might be your second or third property with a view towards development. That could be the handbrake that stops you investing. And it happens all the time. And this comes down to the concept with property investment of simplicity, right? Like, people go too fast to try and do the complicated things. And most people I know, most property investors, if they're not professionals who go down the development path, don't have a good experience. They don't have a good experience. Then there's something to simplicity, Paul. Like it's simplicity rules when it comes to property investing.
Unequivocally. And I can, if I go back to my own journey and experience of starting and then proliferating, my first purchase was a coastal ground floor 2-bedroom red brick apartment. I paid $385,000 for it with a 5% deposit and a $20,000 government grant at the time. And I had 20 grand, not dissimilar to your numbers, Munz, is that I had 20 grand and I had just enough to borrow circa up to 400K. We bought the property. We had very little left over as far as cash. The intention was that it was an old tired property. And the first thing I did when we settled on the property is that we embarked on a 2-week renovation, which was sweat equity 101, which was paint, carpet, blinds, and a freshen up. Now, outside of the materials, it was our time. And my intention out of that was saying, can we get a valuation uplift out of this property? Because in that same block, there was a property that sold about 4 months prior, early in the $400,000. Now, what you were saying earlier, Phil, is that initially it's a small wins. I was looking at, can we get a valuation that's going to potentially release a little bit? And that conversation back with my broker at the time was, what do we need to do? What does a valuation need to be? And how much could we release? And after that 2-week renovation, circa close to 20 years ago, it didn't come back straight away with the same bank. They certainly weren't going to value it above what we paid for its sticker price. We went to 3 or 4 different banks to get different valuations. Most of them were curbside. One came in and said, okay, we'll have a look. That have a look came up with a $450,000 valuation. That $450,000 valuation with a $360,000 debt, taking on LMI and all the other things again, allowed us to release another $25,000, which essentially was our deposit into the property back out. From there, we then ended up looking at a next purchase relatively swiftly after, which was a $181,500 2-bedroom ground floor apartment in Mount Druitt. Again, immediately after that, renovation time. I ended up putting a friend in hospital with a little bit of something that he picked up as part of the help that he gave me.
I went to that property.
You might have. It wasn't. It was
like a villa.
It was a villa. Yeah, yes, that's very nice of you to call it a villa.
I remember who it is. Yeah.
I only literally sold that property a couple of years ago. But I guess my point here is that, again, it was the same thing. That one was a bit more of a renovation where we tore it out, new vanity, new kitchen, flooring, paint, etc. But again, it probably ended up costing me, I think, and these numbers are so vivid because at the time I was so infatuated with the numbers. I remember it was $14,000 cash out of that money that I released from the original property, which again was a renovation, a little bit of a higher valuation, money back out, tenants came in, paid a little bit higher in rent and allowed us to go again. And sometimes it happened quickly, other times we're getting closer to borrowing capacity. But all the while, these conversations with my broker, being aware of the numbers, knowing our cash flows, and living very modest lives was the key as part of all this. And you have to enjoy it. As much as it was hard, it was really hard. You learn so much from it. And not just learn so much as a property investor, you learn a lot about what you're about as a person and what it's like to actually dig deep and find ways to get things done. And it's not just physical, it's the conversations with banks, it's being aware of what the numbers need to be, what banks' policies will say, what other banks' policies won't say, and all these things you learn, you accrue all these details and you become better. And that's what allowed me and my wife to become better property investors and go again and again and again. Because you just pick up these little bits of knowledge and eventually you just become better for the next one, and learn more and ask questions. And, you know, we crossed paths a long time ago, Munzurul, and that led to a whole breadth of other information that I didn't know. And it just kept trading out and you just become better every day.
Love it.
So it is possible, Munzurul.
It is possible. It's the patience game, right? And the patient game in the sense that it's sort of that very longer term sort of a game, number one. Number two, it's that delayed gratification, right? If Paul were to say in day one, on that example, look, I'm not going to get sort of nitty gritty involved with this. I'm going to get someone else to sort of do the repairs and maintenance and painting and all the rest of it, right? Yeah, it can be done. But
Have you ever picked up a paintbrush, Munzurul?
No, I haven't actually.
So you can still get there without doing the sweat equity yourself.
Manuel Labor is Munzurul's Spanish friend. It's certainly not something that he's able to do himself.
I still remember that our first house that we were going to paint, right? And this is our very first house. Pruby and I, we just got married. And how old was she? She was like 19. I was like 24 or something, right? So we got to do all the painting and we've done all the work and everything else. She came in and I sort of started painting after 5
Holding
minutes.
the wrong end of the paintbrush.
After 5
isn't
minutes,
gonna
I was
work out
like,
so well.
this is not my area.
So there's other ways to get there then, like, you've identified your strengths and skills, and you have you certainly within that 1% Munzurul with quite a significant portfolio. What is it you think that set you apart, considering your very Australian migrant journey? You're absolutely representative of everything that migrants can achieve in Australia. But what sort of set you apart, do you think?
I don't know whether it sort of sets apart as such, right? But I sort of look back and I sort of say that I'm being very blessed in many, many, many different ways. Very, very blessed. And I think if I may start with that sense of gratification, that's quite, in my mind, it's quite fundamental. Right? And why do I say it's quite fundamental? Because positivity brings in more positivity, right? And negativity almost sort of takes you on a spiral, right? That what sort of sets apart, everything is relative. And I say that very often to many, many of our clients, particularly the younger clients, right? Is that you don't compare with someone else. You don't compare with myself. You don't compare with anything else. Have your own journey and go for it brutally into your own journey, right? So that's first point. Second point is that I was always being very goal-oriented, and I was always being very accountable to my goal-oriented. And different ways people make them accountable. In my case, what I used to make accountable is that I used to set my goal and go around and speak about those goals to 2 or 3 or 4 different people that I can't make myself fool out of. So I almost used to take away that safety barrier, saying that, well, now you know this is what my goal is, and now you know that I'm expressively saying, Phil, by next year I want to do that. And then what it does is that next time when I see you is that it's not so much you're going to be asking me, but it is in my mind that if you ask, I have to answer the question.
So whether it's the concept, but what you're talking about there is strategic vulnerability.
Yes. It really, really, really works.
Yeah.
So it's sort of play yourself. No one else. It's just you. You yourself play yourself, right? That's number 2. Number 3 is that just that continuous level of learning. You're right that you need to know which area that your sort of strength is and which area isn't, right? And then sort of the physical renovation, I sort of always struggle. But you need to know that knowledge, whether it is an accounting side of it, whether it's on your finance side of it, whether it is your just to knowing your portfolio on an ongoing basis. Keep asking the question and staying into the game. So in my case, quite truly, if I look back and if I show all my portfolio, you would look back with the portfolio and you would say, literally for the first 15 years, 17 years, is that when I bought all of those properties, they were very ordinary property as they were. But if I look back now, and if I show some of those properties and if there is a new investor will look into it and say that, wow, you are so lucky that you've got this property. But it was not so much luckiness because that in day one when I bought, it was a very ordinary property. The fact that I hold it for 15 years, that means the whole area has become rezoned and it becomes quite exceptional. That one example that we were speaking just prior to this is the example, a property I've got in Dinmore. And I still remember that I bought this property probably 20 years ago for about 135,000 and 1,000 square meter land. A terrible property, terrible. It should be demolished at that sort of property as such. I bought this because that's all I could afford at that point of time. I said, all right, I'll leave that as such. Nothing can be done with that property forever. I was being told, even the real estate agent, right? You buy that as it is, as one of the cheapest sort of property now. We look back now, that property after 20 years, whole area being rezoned, I can build up to 5-6 stories apartment, or at a bare minimum, I can have 6 townhouses, and the margins are exceptional. So now people look into it and say that a client can look into it and say, wow, you're lucky you've got this. But it's not so much the luck, it's the fact that I've done it for a very long period of time.
So coming back to this theme of what the 1% do
Yep.
to sort of create large portfolios, and my phone is going off right now with these idiots out at this surf park from Flow State with their videos of them getting barreled, and I sit there and I think about compromise, right? And this is absolutely got to be it's a thing for the 1%, and this is this concept of two sides. That you can't do everything at the same time. You've got to give up certain things in order to achieve other things, right? So, this idea that everything's got to work out and you can do everything you want every single point of the time, that's not the way life works and not the way reality works. So you've got to be committed and you've got to make choices of what you're doing at a bit in time. If you actually want to invest in property, you've got to potentially compromise other things. And it might be lifestyle, it might be holidays, it might be new cars, it might be not sending your kids to private school versus sending your kids to private school. So this is this notion of compromise. So in order to own multiple investment properties like the 1%, you're not going to be able to do everything. So you've got to choose what you want. And this is something where I think a lot of people struggle with property investing, is that you can't do too many things simultaneously. And if you want to be successful in property investment, there needs to be a period of time where you're absolutely committed to doing it at the compromise of other things. Your story, you spoke to that, starting off young investor, you spoke to that. We've all done that. And a lot of people aren't comfortable with that, that idea, number one. Number two, this idea that you can't fight on too many fronts simultaneously. So, you can't be exceptional at work, exceptional at home, exceptional out on the social scene. You can choose one of those things and prioritize it, and you're going to get that right. But you cannot be fighting everywhere all the time, because again, you're just going to be diluted down. And you're not going to get what you want. So this is a philosophical thing back to mindset. You've got to get your house in order. You've got to get certain things working well so you can fight hard in other areas. So if you want to be a good property investor, get other parts of your life in order. You don't want to be in a relationship which is sucking all your time, energy, and effort and negativity. You can't be compromised financially by having large credit card debts and all this sort of stuff. So you must see this in your client base. People have probably got their stuff sorted out in certain aspects of their life so they can actually fight hard on the property investment side.
There's a few key points you've raised there, I think, Phil. And it sort of makes me reflect a bit in the sense that we're probably lucky, the three of us, that we actually came from humble beginnings, because by virtue of that, we then didn't necessarily have these great aspirations for things which we now have, but we didn't aim for these things. This wasn't our purpose in the first place. That in itself is luck. Now, I'm not suggesting everyone else is going to be in that position. Now, that didn't mean that we had anything given to us, quite the opposite. But there's probably a couple other things as far as compromises that we'll have to make early in the piece. One of which, and I'll go back to a point that Munzurul made a second ago, but one of which is buying your principal place residence and your big old-fashioned, hey, this is where we're going to put our anchor in the ground. Yeah. That's a big compromise because there are very few 1% property investors that I work with that went down that avenue first. That was a choice.
Very important point.
That was a choice that they went down later in life. Now, I can speak to us. We're seasoned property investors, been in this game for a long, long period of time. And each of us have only really just now got to the point where we're looking at what home we want to be in for the rest of our working careers, or even after that as well. That was an active choice, and that came later, and that's the delayed gratification, and you can't have it all immediately. The second part, which Munzurul brought up with his Dinmore property example, which a lot of the time people are reluctant to want to do it, but you have to bury your ego at the start, and you have to buy what you can afford. Now, that doesn't mean that you buy the cheapest thing that's available, but you have to, if you want to continue to create momentum in a portfolio, you have to think, okay, well, the compromise is I don't buy, or the compromise is I buy what I can afford. And within all the other reasons and variations, I still need to focus on the main fundamentals of why I'm buying this property. But if I'm going to wait 5 years, 8 years, 10 years, which is a trap that a lot of people fall into, thinking I'm going to wait till I earn more money or have a bigger deposit, that is what puts people backwards, ironically. So they're probably the key aspects which I want people to really take into account when thinking, how do I proliferate and get to that 1%? Buy what you can afford when you can, as long as you don't compromise completely on the asset type. And there is going to have to be a decision on, does your principal place of residence come up front or does it come at the back? And the reason why I'm very comfortable to say that it doesn't need to be up front is that there are very few property investors I work with who, A, are buying a property which they actually know that that's where they want to be for the rest of their lives. Most of the time, they're renting or they're living with family, or they're potentially in a share house, or they're in an early situation which might be their starter home, but know that, hey, if I had my way, I probably want to be over there. I can't afford there now. Well, you might be able to sell everything and go and buy that, but that's not going to then allow you to have this ability to build a property portfolio which is actually going to fund this lifestyle that you want. So that choice is a big key part up front as well.
Yeah, it's compromise is really important.
Massively.
Absolutely, wholeheartedly agree, right? So that sort of whole delayed gratification, that sort of prioritizing, right? And that sort of whole sort of a risk profile, all of those, 100% agree. If we look through a little bit on the mechanics side of it, yeah. So the mechanics side of it is that, yes, one needs to have that knowledge, which is that sort of the, I suppose, the technical knowledge, so to speak, know enough in terms of finance. I think equally with that knowledge side of it, one also needs to have the operational knowledge. Now, we're not going to know all of those in day one, but we learn it along the way. So if I look back into sort of many of those sort of the clients who's got a big, large portfolio, very often they start with those residential property, right? Over a period of time, one becomes 2 or 3 or 4, and they're very slow. It could be, this is assuming no inheritance, you start with your balance. 1 property per year, 1 property couple of years. That's fine. That's okay, right? Very slow. In the first 5 years, all they have bought is about 3 or so properties. That's okay. Those few properties is that once you start buying 1, 2, 3, 4, there could be a point of time that you sort of say, okay, what is my need? You start with the growth because that gives you the equity to go a whole lot of things. You get restricted with the cash flow at a point of time. The growth will continue for 2 reasons. One is that it could be manufacturing growth, but more importantly, it's just the natural growth, right? Rezoning and the area sort of increases, median price, everything sort of goes up. So as long as you've got a reasonable base, your growth will continue. Then comes in the cash flow. And the cash flow is the one, irrespective of whatever we are, is that at a point of time we get restricted in different way. So then you sort of say, okay, so what's the mechanism with the cash flow side of it? Then you change the strategy a bit more. What worked in day 1, now in day 10, we slightly change. What do we change? There's a whole bunch of mechanism, right? We can go back with the residential property, all those granny flats, and so we can increase, we can subdivide the land, we can build this. Some of those are quite profitable if we do it in the right way. Then we also look into commercial property. Over a period of time, there could be time and a space for the commercial property side of it, right? It gives a bit more cash flow. Whether it does give that much growth, yes, you can still manufacture that growth, but one argues that residential, commercial, both are important. The other point which I want to say quite expressively is the diversification behind it. So important in the longer period of time. If you buy all of your properties into one area, irrespective of wherever it is, whether you buy in Sydney, whether you buy in Brisbane. I remember there were years and years and years I looked into Brisbane up until recently, and we said that, wow, it seems so cheap. There is so much value to it. And then everything gone up quite a bit, right? Now we're sort of looking back into Melbourne and we say, oh, that looks pretty decent, right? And now we look into on the other side of Perth, and whether we say it is a little bit pricey as such. But in an ideal world, would it not be lovely to have few properties in Sydney, few properties in Brisbane, and few properties in Melbourne? So you would always have 1 or 2 market not doing as well, but you've got 1 or 2 markets which are going quite a bit, right? So that number 1 is the diversification, number 2 is the cash flow, and number 3 is that ongoing manufacturing of that cash flow. So all of those technical, all of those operational knowledge, so to speak, add that away with the technical knowledge, and then the equal component, if I may, is that tax and accounting side of it. You add that away, that mix is the one which gives that number of properties.
So it can be done.
Yes.
But it's not easy.
No, definitely not.
And the numbers reflect that.
Definitely. May I just share this? I remember that many years ago, I went to this conference, which probably shows my age, right? I went to this conference of Jan Somers, right? Many of the younger members, they don't even probably know the name of Jan Somers, right? Let alone being into a physical conference with Jan Somers, right? Jan Somers sort of came in and the first thing she did is that she sort of went through with all the newsletter article for about like 20 odd years, just a snippet of it, all the way back from 1950s and 60s and 70s and 80s. And the message was very consistent. What was the message? All properties are expensive. The properties are so expensive. Our next generation would never be able to buy any properties, right? We are right at the top of the OECD countries. Look at that income side of it with the median price. It doesn't make sense. It's that it cannot be done too hard, too difficult as such. And she was going through with that exactly same consistent knowledge. And then what she was concluding, she concluded saying that, well, it was always hard. And it's still hard. And it would always stay hard in the future. That is not going to change. But what's going to change is that how are you going to still make it work within that mechanism? And there is a pathway in many, many, many different ways. And that is what we need to concentrate.
Good conclusion, Munzurul. And let's be clear, for a lot of people, they might not want to be in the 1% of people with property investment. But to Paul's earlier point, you don't need 5 properties these days in order to create a comfortable retirement if you start at the right time and hold on to them. So lots to this conversation, this sort of intersection between mindset and conceptual stuff versus strategic and tactical stuff. Paul, you're happy to work with clients on all these things? That's what you guys do?
This is exactly what we do. And these conversations are the big ones, particularly with new clients up front, is to try and shape this really early, to try and say, hey, let's try to figure out what we need to get to, and B, how do we get there with the first point? And the first investment is really where we have to focus on, and whether that's you've got nothing and you're starting, or whether you've got a home and you're looking to use equity, or you're living at home and you're trying to use a guarantor loan from your folks or someone else. That's the key conversation. So inquiry at purepropertyinvestment.com. You can give us a call, 1300 98 5428 to set up that first meeting, because for me, that's everything. Without that, the rest of it is a bit of a fugazi, as they say.
A fugazi. And the key thing to all this is accountability and ownership, and only the investor is accountable and owns their own journey. So if you want to invest like the 1%, you've got to be a participant, and it's not going to happen without you working hard on it. So no doubt that's probably some realities that you have a chat with your clients about.
And we
the
have
front end.
Not just the front end. And I say this because we buy a first property for a lot of people, because that's typically where the journey starts, but we catch up and we actively reach out typically every 12 months after that first investment to have that conversation. How things been tracking, we give them a retrospective understanding as to what happened to that property over the last 12 months. A lot of the time, 12 months is nowhere near enough time for a property to actually have any true impact. But, as 2025, as an example, it grew by circa 8%, the national market. 8% on a $500,000 property, that's a $40,000 increase. Ultimately, these are the things we say, okay, well, what can we do with that? Have you spoken to your broker about where and what? Has there been any changes in your income? Have you had conversations with your accountant, or is there somewhere where you need to have that conversation to start to draft those things, and holding people accountable to say, your next steps from this meeting are X, Y, and Z. And that conversation goes on and on and on and on. And without those ongoing accountability conversations, I typically find people don't push much further than that first property. Yeah.
Nice one. Munzurul, thanks for your time. You can track you guys down as well. Just look up KHI, no doubt. If you don't yet have an accountant, Munzurul's books are full. You're not allowed.
He's got some good team members.
Great team members. But no, thanks, gentlemen. Thanks for your insights. And the point being is that in our own particular way, we cover a lot of this market. So we've seen all that's great around property investment and all that's not so great around property investment. So if you are going to invest in property, make sure you do it the right way. This is the Pure Property Podcast with Paul Glossop. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.